Good morning, everybody. This is the live market open for April 5th. I'm Yohay, Forex Crunch and Market Movers podcast, doing this show as usual for FX Street. As usual, we'll cover recent developments in markets, talk about various charts and levels, discuss the upcoming events. It's a very busy week, the first week of the month and of the quarter. We'll preview specifically the Non-Farm Payrolls, which comes on Friday as always, and our currency of the week is Aussie against the US dollar. And finally, we will discuss the week ahead, the week leading into Easter, before wrapping up. And most importantly, your questions are more than welcome. If you cannot see the chat box alongside the screen, please go to the address here, tlk.io/fxstreet-forex-live-video. All right, so good morning, everybody. Let's begin. What's going on in markets? The mood, well, there isn't much going on. Unfortunately, volatility is relatively low, but in general, the US dollar made a comeback and then stalled a bit. We're now in a bit of a wait-and-see mode. We have big events ahead of us. The US dollar made a comeback thanks to, well, it was consumer confidence that came out better than expected. That was the signal. But in general, the bigger motive is Fed officials that were more upbeat, okay, more positive on the outlook about really raising rates, a bit less dovish. Remember the dovish hike, so it's a bit less of that. But anyway, we also had other news from the Fed tonight. We heard that Jeffrey Lacker of the Richmond Fed was, he resigned because of, he leaked some critical information to a company back in 2012, and he was forced to resign. Anyway, I don't know how that will impact the dollar, but it's something worth noting. Anyway, in the political scene, we're hearing now about another attempt to pushing through with Trumpcare, a Republican plan to repeal and replace Obamacare. So far, no impact on currencies, but watch out for that. We had the second French televised debate last night. It was very, very long. All the 11 candidates, even the most obscure ones, came on stage and got equal time. The picture, as far as I know, from all the recent polls remains unchanged. It's expected to be Macron against Le Pen for the second round, reaching the second round, and then Macron is expected to beat Le Pen. Macron is centrist, Le Pen is an extremist, but Fillon could still, from the center-right, could still make it to the second round. The ECB, why is the euro falling? More specifically, the ECB reclarified its statement about, remember, they deleted the wording about using all instruments and told us that there's a lack of no more sense of urgency. So they told us now that they didn't want to tell us that they're going to begin tapering QE or exiting soon, just that the tail risks, the most extreme cases, are eliminated. So that hurt the euro. Last week, that was exactly 1 week ago when we had the show, Article 50 was triggered, and pound was stable. That was a bit of a disappointment. There was talk about a short squeeze in the pound that would be triggered after the event happened, or that the bad news would hit the pound, and eventually just nothing happened. And unfortunately, there was a terror attack in St. Petersburg in Russia earlier this week. We heard about, well, other bad news in the world. The Assad regime gassed its own citizens in the north of Syria, in Idlib, and, well, there's a missile in North Korea. So far, again, not too much of an impact on markets. Let's talk a bit about the data. Good morning, Ed. Good morning, Magdi. Good to see you all. The chat works indeed. All right, so let's talk about some data points. We covered, Valeria Bednarek, Mauricio Correa, and I, the US Q4 GDP on Friday was upgraded to 2.1%, still a bit mediocre, still not convincing enough, and Q1 looks a bit poor. Jobless claims also on the negative side, they look a bit high, remaining on higher ground, 258,000, but so far nothing to really get excited about. The Fed's favorite inflation figure, that's the core PC price index released on Monday this week. It came out at 1.8%, a tick higher. That means that's positive for the US dollar. And another piece of good news, the ISM manufacturing PMI, the first hint towards the non-farm payrolls, came out at 57.2. including a strong employment component. So on the labor side of things and inflation, the Fed's mandates, things are still mostly positive. Yesterday's trade balance was better than expected as well, 43.8, and factory orders came out as expected, 1%. All in all, I would say things are looking okay, but certainly not exciting in the United States. So there's a bit for everyone, if you wish. Elsewhere in the world, another thing that hurt the euro that came on top of the ECB comments is that inflation is falling. So a headline figure fell from 2% to 1.5. A drop was expected, but not this big. And perhaps more painfully for Mario Draghi, the core CPI, the index that excludes energy prices, food, slipped to 0.7 euro for a year, and that could be even a bit worrying. Elsewhere, Canadian GDP beat expectations at 0.6. Our currency of the week, the Australian dollar, retail sales, they were disappointed, but the trade balance came better than expected. China's Caixin PMI was a small miss. And in the UK today, we have the most important PMI, but so far we had a few disappointments. The manufacturing PMI dropped to 54.2, construction 52.2. These are forward-looking indices, and they imply that the growth rate is slowing down in the first quarter of 2017. Okay, you see here some comments from Ed. Good morning, Gillis. It says all BS mainstream media that Putin is behind Le Pen. Is he really going to risk his 65% reserves in euro and Europe? He needs Europe. Yeah, I don't think he. What we learned, at least from the U.S. case of Russian intervention, according to those officials over there well, the intelligence officials in the United States, is that Putin, Russia, they don't want the adverse leaders. They don't want a mess. A total disaster. What they want more is some loss of confidence in democracies in the West. To bash the narrative that Russia is going into an authoritarian mode while Western democracies are flourishing. So he wants to sow some confusion, instill some distrust. I don't think he really wants to see Le Pen, but of course, there is some evidence. Russian banks gave loans to Le Pen. Le Pen said that the annexation of Crimea is justified. So she just visited Le Pen just visited Putin a few weeks ago. So 2 weeks ago. So they are fond of each other. But yeah, I agree that they don't want to risk too much. They don't want to mess things up too much. They don't want to risk their reserves, as you say. Okay, I hope this answers the question. Replies to your comment. My 2 cents. And let's continue with more pieces of data and finish the data. Okay, so let's move to the charts. So this is our technical segment, lines of support and resistance for major pairs. It's the first week of Q2. So let's begin with euro-dollar. As we've seen, euro-dollar last week made a move to the upside. So our top line here is 109.05. It's followed by 108.70, which was the high back in December. You can see that line right here. Okay, followed by 108.30, which was the initial 2017 high. We crossed this line, of course. It's followed by 107.75, then 107.30, and we're currently at a lower range. We're seeing this 106.30, which was resistance back in March, now working as strong support. We're bouncing off that line and moving a bit to the upside. If we lose 106.30, I see support only at 105.20 and 104.90, that tight area. Okay, further below we have, of course, the 103.40, the 14-year low. Moving on to pound dollar, look at the lack of reaction to Brexit. So we did see some kind of a fall last week, but we never went too far. Lines that I'm eyeing now, 124.15, you can see that as immediate support, followed by 123.50, a stepping stone to the upside and the low back in February, 122.50 and 121. To the top side, we have 125.70, and then stronger resistance 126.20, which was the highest level in about 2 months, then further above 127 and the initial post-Brexit low of 127.90. Dollar yen, look at this stubborn 110 line. Of course, very, very round number over there. And what do you see here? Double or even triple bottom? Or are we seeing lower highs here? Anyway, in any case, 110, the 110 level is a very hard nut to crack. It seems that the pair is reluctant to fall below that. Maybe it's fear of BOJ intervention, either verbal or real intervention, to weaken the yen. Anyway, the current range is 110 to 111.60. 111.60 used to be that triple bottom, and it took the pair a long time to break that. Above that, we have 112.20, and then which was the post break high, and then 113, 114, and 115.50. Below 110, we have 109.50. Okay, so that's dollar yen. Dollar CAD, Canadian dollar, very much also here in range. We see clear support here at 132.65, followed by 133.80, and resistance 134.60, an old line that remains relevant. Further resistance 135.35 and 136. Below 132.65, we have 131.80 and 130.80. Aussie dollar, a currency of the week, which we'll reach later on, is currently on the slide at 75.83, support there at 75.40 and 75, resistance 76.10, the old line 77 and 77.50. And Kiwi dollar hugging the 70 level, which is not support, not resistance, currently a bit below the level, so 69.50 and 68.80 and 68.20 are lines of support. Resistance 70.40 and 70.90, which is even stronger resistance, followed by 71.25. Let's mention dollar Swiss just above the line of parity. Parity support followed by 99.60, and then 98.90 and 98.20. Resistance 101, and then 101.70. Okay, so this concludes our segment for major pairs the first week of Q1. All right, let's continue to the crosses. This is our technical segment for crosses, lines of support and resistance, first week of Q2 2017. We'll begin with Euro Swiss. Not much to talk about that, so we can currently just above 107. You can see that 106.80 is some kind of support, least support for the Swiss National Bank, which intervenes in this currency pair a lot. Further support 106.25, then 107.60, 107.90, and 108.25. Euro pound, the Brexit pair, much more interesting. Currently at 85.86, resistance 86.20, 87.80, and strong resistance at 87.90. Okay, support. The level here where we bounced off just recently is 84.80. 84, the round number, is also strong support, and 83.30 is below. Euro yen made also a move to the downside. Also here we have some limits on how low the yen how low this cross can fall, how much the yen can strengthen. So 117.40 is where we bounced off. Currently 128.30, battling with the support here. 120, the round number, then 120.50, 121.30, and 123. And for some of you, it's the favorite currency pair grinding its way to the downside. Pound yen, the Gepi, 137.75, support at 136.40, 138.60, resistance, well, sort of a pivotal line, followed by 140.53, 142, 142.80, and 144.80. Strong support there at 136.40. Let's see if we break to the downside, and we'll conclude our technical segment for crosses with something else, as usual, with the oil. So we're seeing a turnaround in oil prices, currently 51.40 on WTI crude oil, 52, the round number, worked as a resistance for many months during 2016, and does its job again right now. 54.50 and 55.20 are lines to the top side. 49.50 is support, followed by 47, a triple bottom here on the chart, and way below 44.50. All right, so that's our technical segment for crosses. And now let's move on to other topics on our agenda. What are the big events coming up this week? And it's quite busy. So today we have, just after the show, the UK services PMI, the most important. In most developed countries, the services sector is the largest. We'll have a forward-looking indicator about the economy in the United Kingdom. The big hints towards Friday's non-farm payrolls come today. It's the ADP NFP, which has a better correlation in recent months with the official BLS jobs report, and that report also for the services sector in America, the ISM non-manufacturing PMI at 2 GMT. For those trading the rising oil prices, we have a big test with crude oil inventories a few weeks ago. It was the trigger for a sell-off. Let's see if it manages to halt the rally this time or just fuel it, pun intended. Anyway, we have the FOMC meeting minutes. Those are meeting minutes from the March 15th decision in which the Fed raised rates but went dovish. Let's see if they maintain their dovish stance also now. Okay, it should be, well, it can be a snoozer, the FOMC meeting minutes. In some cases, markets totally ignored it, turned into a non-event, especially when it followed meetings that were accompanied by a press conference like this one. But they can also move markets quite a bit because we're quite unsure about the next moves of the Federal Reserve. I would also stress that despite being, in theory, a 3-week-old document, okay, a documentation of what members talked about in that meeting on March 15th, the document is revised until the very last moment. That means they know it, markets sort of scrutinize every word there, and they want to, and the Federal Reserve members want to convey a message to their liking. So that's why the last minute editing, and it has an impact on markets. Okay, tomorrow, relatively lighter day. We have ECB's Mario Draghi speaking. This week he already talked, but did not move markets because it was just a presentation of a new 50 euro banknote. And we also have jobless claims in America and German factory orders. And on Friday, of course, the big day, warm up with UK figures, industrial output, trade balance, and a speech by Mark Carney, the governor of the Bank of England. And then, of course, non-farm payrolls, as well as the Canadian jobs report. And that will be our next segment. Well, we'll first talk about the Aussie and then have the NFP preview. So non-farm payrolls, of course, the culmination of a very busy week. All right, but today we have the FOMC ADP. So today and Friday are quite busy. Could be quite messy. I hope they will be. Volatility has been a bit low of late. All right, our currency of the week is Aussie dollar. Here is the beautiful Opera House in Sydney, a map of Australia, and well, one of Australia's natural symbols. All right, but let's talk about economy. Let's talk about Forex, about the Australian dollar. It used to be a great technical pair, respecting lines of support and resistance. It's still okay, but it's stuck in range for a long time. The pair is better when it is trending. In general, the Australian dollar is a risk currency. That means it usually rises with stocks, with commodities. It's a commodity currency. With a good mood in markets, it's a risk-on currency. Remember that because the dollar is not always like that. Okay, the US dollar. So that's generally about Australia, the Australian dollar. Let's talk about the Australian economy. The Australian economy relied for a very long time on the mining boom, iron ore, copper exports to China in general, but it's gradually moving away from mining. It has been boosted by the recent rise in commodity prices and renewed Chinese demand. So we have the Chinese Party Congress coming up in October, November, and the current regime there in China, led by Xi Jinping, which is going to visit Trump this weekend, they want to keep the economy running. It's strong growth. That means using the normal motors of growth, like industry and exports, and they're not moving away, and that's good for Australia at the moment. So even though the Australian economy is gradually moving away from mining, it's eases the transition if Chinese demand remains strong. What else is going on in the Australian economy? The jobs market disappointed last time, but all in all, it looks stable because we had a few good months of nice job gains. So it's all in all quite stable. Inflation is slightly low, a bit under what the RBA wants it to be, but it's nothing terrible. So all in all, if we look at these main indicators, things are okay. But we could find some worries about, as always, I must say, it's running already for a few years, about the housing sectors. Homes in Melbourne and in Sydney look a bit frothy, as the Fed used to say. And we should look out for any macroprudential measures that could substitute rate hikes. That means if the RBA, using its powers as a regulator, decides to limit mortgage taking, trying to cool the housing market, but without raising rates, to do that, we could see the Australian dollar fall. So far, they haven't been doing too much in comparison to their counterparts in New Zealand, for example. The RBA, which made its decision this week, did not make any changes and is not seen as making any changes later this year. They kept things quite balanced. They kept their same wording about the Australian dollar, which was that a stronger Australian dollar would complicate the transition away from the mining sector. Basically, no change on that front. Let's talk quickly about the United States, because we're talking about Aussie against the US dollar. We're still looking for direction after the Donald disillusion. So President Donald Trump, his administration is not getting too many things done. At least we had the colossal failure of Trump Care and taxes. They're moving very slowly. So the US dollar, which rallied on Trump's election, is now looking for any direction. Still not a total disappointment, not an undoing, but sort of doesn't have the fuel, doesn't have the energy. The Fed it made its dovish hike, but they're still upbeat, so they bounced things out. Watch out for today's FOMC minutes, perhaps, for more clues. Slow growth in the United States, we talked about that early in the show. It could weigh. So far, the jobs market is rising quite quickly despite slower growth, but this could change. And the US dollar, it's important to remember, is a secondary safe haven. So if we have a violent correction in stock markets, okay, the Australian dollar is a loser, and the US dollar will not gain as much as the Japanese yen, but it is set to gain. It's a secondary safe haven. So what's next for the Australian dollar? We'll look again at the charts, but before that, all in all, things look stable. Look for issues in Australian housing. I think that's sort of the underreported story regarding the Australian dollar. Or perhaps on the positive side, we could see stronger Chinese demand, even stronger Chinese demand ahead of the big party gathering, the Communist Party in China. But for now, the movements in the Aussie dollar depend a bit more on global markets and stock markets and on the US dollar, okay? So, of course, events in Australia and China matter, but I think they matter a bit more in the United States. So let's look at the Aussie dollar chart to complete this segment. It's the daily chart. Currently, we're at 75.86. Support here at 75.40. 75. Below that, we have 74.50 and 73.75. To the top side, 76.10, which was the initial stepping stone on the way up. 77, 77.50, and even further above, 78.40. But currently, we're a bit stuck. Right, I see here a comment by Ed. If minutes of a corporate meeting were to be revised last minute, like the Fed does, it's called fraud and misrepresentation, but the Fed does it, no one screams fraud. Well, the minutes are not revised, they're actually released for the first time, but they take their sweet time in releasing the minutes. I must say that the Bank of England, they changed their the way that they work, and now they release the meeting minutes alongside the rate decision. So once the decision is out, you can read all the protocols. And also there, of course, they could change what it doesn't have to actually reflect. You have to be in the room to really know what's going on. but yeah. So, but this delay of 3 weeks allows the Fed to decide what message it wants to convey and sort of set the tone. I believe it is a true representation of what happened, but the tone, the messages can differ. All right. And had a comment about the Fed, and let's talk about the figure that moves the Fed most. Jobs in America, it's the first Friday of the month, coming soon. It's the king of foreign exchange indicators, moves markets most. Had its bigger days in the past, but still is a key indicator. U.S. non-farm payrolls on Friday, 12:30 GMT. Let's provide a bit of background. So the last report, the report for the month of February, came out early in March. It came just before the March hike. It came out, remember, on March 10th. All right, 5 days before the rate decision. Maybe the Fed officials already had the figure because it was released that late because of, well, February's short month. Anyway, 235,000 jobs gained. Excellent news. And wages rose 2.8% year over year. Also great news. Unfortunately, in that specific Friday, markets focused a bit on the miss, or on the month over month. That month over month miss was accompanied by an upwards revision for the previous month. All in all, a job market is ahead of current growth, is growing very nicely. Jobs are rising. That means the U.S. economy is not only our just a second. It's okay. Sorry for that interruption. All in all, the U.S. jobs market is looking good. Not only good enough to we're seeing good gains in jobs, but employers are willing to pay more money to employees, so it's good news. And what about the Fed? Okay, the next Fed decision is in May. No press conference and no new forecast. No chance of rate hike in May. They'll tell us each time that every meeting is live. Well, they need to justify their pay, but nobody expects them to move. Therefore, the figures will accumulate. It's not sort of the final figure, the yes or no for a rate hike. It will accumulate together with the next jobs reports, together with lots of other data points. Okay, but of course, it will move markets on Friday, and it still remains the king. All right, NFP. What's on the cards? So according to expectations, 176,000 jobs are expected to be gained in March, but these expectations will further change today with the ADP and the ISM manufacturing PMI. Last time they didn't move things too much, so anyway, it'll be in the vicinity of those amount of job gains and wage gains. 0.2 month over month, more of the same, around 2.7, 2.8 year over year. All in all, I see these expectations as relatively modest, sort of a bit under recent good data, and but well, maybe it is realistic because last time we really had an excellent report. What does it mean, the non-farm payrolls for the dollar? This time it's really straightforward. 1.1 plus 1 is 2. Okay. Wages are still important, just a bit less important than last time. Last time they were sort of really the key. So I see it, well, no specific bias against the dollar or for the dollar. If we have job gains and wages coming out ahead of expectations, beating, dollar should rise. If they miss, the dollar will likely fall. If it's a mixed outcome, wages should still have the upper hand eventually. Okay, more than the change in jobs. But all in all, it's straightforward. Last time it was asymmetrical. Last time we needed a really terrible figure to push the dollar lower. We didn't get that, and everything was okay. Now this time it's very symmetrical, very straightforward. So less of a focus because we're not just before a rate hike, a big rate decision, but I think maybe this calmer atmosphere should provide better opportunities to trade it. Okay. So before you move on to the preview for next week's events, I see here another Question from Hans. What is odd mostly moving into if they are moving away from mining? Well, the Australian economy, well, it's a modern economy, of course, and they have other things going on for them. So in Australia, they also manufacture, for example, all kinds of goods for surfing. They produce wine. They have well, heavy machinery as well. There are a few. Well, there's the car industry in Australia as well, and agriculture. They have also, well, cows, sheep, and tourism, of course. You've seen Crocodile Dundee, and it's a big economy. It's a developed economy. It's not only mining, and another thing that fuels their economy and they have a more problematic relation with is money flowing from outside the country into the housing sector. Okay, so in theory, it's good for the economy to have money flowing from outside, and it creates more demand for housing, but it can turn into a bubble. So if Australia sold, well, building materials to China, iron ore, copper, now it comes the other way around. Chinese, rich Chinese, the economy there is growing. There's a wider middle class. They are buying homes in Australia, much cleaner air, democratic country, very high standards of living, one of the best countries in the world. So that is also keeping the economy balanced. Okay, I'm no expert on the Australian economy, but a few things I am familiar with. I hope this answers the question. Okay, let's continue to. This is the preview for the week of April 10th to April 14th, the week that puts us, it's here in Spain, Semana Santa, a holy week. We're entering Easter. Okay, so Friday is Good Friday. It's a relatively quiet day, but not exactly. Okay, let's, Monday, nothing much, more echoes from the non-farm payrolls. No key indicator from anywhere. On Tuesday, we have the UK inflation report. Inflation is rising in the UK, eroding real wage gains, even making the standards of living fall. So it's important for the UK. German zoo business sentiment published on also on Tuesday, indicator for the German economy. Wednesday, busy day. We have Chinese inflation figures for those trading the Australian dollar. The jobs report in the UK. Most importantly, I would watch out for wages. Let's see if wages, how wages fare against inflation. Rate decision in Canada, no changes expected. They're expected to express worries about the price of oil, which remains low, and perhaps have a slight dovish bias, but very, very limited, and oil inventory. So we're going to have a busy hour or so around the Canadian dollar. Thursday, just before the long weekend of Easter, we have the Australian jobs report. Expecting to see a small gain in jobs after a loss of jobs last time. Chinese trade balance, so it's sort of Australia Day there if you're trading the Aussie. Big events. And in the US, we have the producer price index, jobless claims, and also consumer sentiment. The influential University of Michigan's consumer sentiment, this time released on Thursday because of Easter. And you think that Good Friday is a holiday? Yes, in most places it is, but the United States still releases a few figures. And these are top tier figures. Retail sales, the US economy is all about consumption, and we have that figure released on Friday. Well, most of the world is on holiday. And at the same time, and they also release inflation figures, also top tier, of course. The Fed has another favorite inflation figure, but it's still of high importance. Okay, so that is the week preview for the week of April 10th to April 14th. Okay, you're welcome, Hans. Okay, so it's time for a wrap up. So this is the wrap up for the live market open for April 5th. We're at the beginning of a new quarter. It's springtime in the northern hemisphere. Markets are a bit stuck though, a bit in hibernation, in winter mode. The US dollar made a comeback but stalled, waiting for key events. Today we have the FOMC meeting minutes, and also big hints towards the non-farm payrolls, and of course the non-farm payrolls on Friday. Fed officials are relatively upbeat, but in comparison to their some dovishness a few weeks ago. In politics, watch out for another attempt at Trump care, a test of the ability of the Trump administration to make changes to the US economy. In the Eurozone, the second French televised debate was very, very long, and until we get new opinion polls, we should get them today, nothing has changed. The ECB reclarified its previous statements, was a bit bearish. This was exacerbated by weak inflation figures. And in the UK, nothing really big happened after Article 50 was triggered. Watch out for headlines regarding the negotiations, trade, immigration, and things like that. Key data points to cover. Well, US figures are basically mixed, but today we have the ADP non-farm payrolls at 12:15 GMT, and then the ISM non-manufacturing PMI. These should influence the dollar and shape up expectations for the non-farm payrolls. We have today the FOMC meeting minutes. Remember, the document is revised until the very last moment, so the Fed officials know that they can influence markets, and they do take the opportunity. Tomorrow, well, sort of a day in between, and Friday we have the non-farm payrolls, of course, very big event. Let's mention some of the expectations a bit quickly in our wrap-up. So last time we had a really great jobs report. This time expectations are a bit lower, 176,000 jobs gained. Of course, expectations can be changed, and 0.2 in wages. And trading should be quite straightforward this time. No specific bias to the upside or to the downside. If both figures, jobs and wages, beat, it's good for the US dollar. If they both miss, it's bad for the US dollar. And if it's mixed, wages should have the upper hand eventually after a struggle. Let's run over the charts a bit quickly. So no big movement in markets this morning. The biggest mover is here, where in major pairs is the Australian dollar, which is moving a bit to the upside. We're at well, 20 pips to the upside, and resistance 76.10, support 75.40. Let's go back to the top. Euro dollar moving a bit to the upside, recovering from previous falls. 106.60. Sorry, 106. Yeah, 60 is support. Resistance is at 107.20. Pound dollar currently at 124.40. Support 124.15. Resistance 125.70. Dollar yen found it very hard to break under 110. 110 to 111.60 is the current range. Dollar CAD just under 134, 134.60, and 133.80 define its range at the moment. We talked about the Aussie, and in the Kiwi, 69.80 at the moment, just under 70. Support 69.60, resistance 70.40. Let's see if euro dollar will move on opinion polls. The next one is at 10 GMT from Opinionway. I'll be watching to see if we have any movements resulting from the elections, sorry, from the debate last night. Okay, so all in all, very stable markets. Big events ahead the first week of the quarter. Let's see if we have some questions. No. Okay. So, yeah, hopefully we'll see a bigger movements in the markets. It has been a bit disappointing what we've seen in recent days, especially, I must say, the reaction to Article 50. Where are all the short squeezes that we were promised, or is the big downfall? At least dollar yen is moving, but hasn't fallen off the cliff. What about well, euro dollar? We had some action last week. Now it's a bit stuck, looking for a new direction. French elections, we'll keep talking about them more and more. Of course, they're getting very close. April 23rd is the first round. May 7th is the second round. Eventually, I believe that French opinion polls will sort of be at the forefront and will move markets a lot more. Currently, it's one of the stories that is running in the background, growing in intensity, but still not as prominent as I thought it would be. Yeah, maybe we're at the calm before the storm. Okay, so just have one look at questions. Thank you, Ramon. Yeah, well, thank you guys, everybody, for coming. Hans, Ramon, Ed, Geddes, Magdi, and anybody else watching. As usual, you can watch all the video clips on FX Street and later on also on my site on Forex Crunch. I wish everybody a safe and successful trading day today at the markets, and see you our next live coverage. One more administrative note. Next week the show will not be on Wednesday morning, but on Thursday in the US session in the afternoon at 1 GMT. All the information is always on FX Street. That's because I'm traveling, but don't worry, we'll have a full show as usual. And so that's it for today. Thank you very much. Cheers and safe trading. Thank you and bye-bye.